we're back and we start with a bang, don't we?
Yes, we absolutely do. So our first episode back is with two people who've been on the podcast before. We've got Paul Demarco and David Lauder from ESPC Mortgages, who are two of our mortgage advisors.
Shooting straight from the hip with all things mortgages. Really good advice and go into a lot of detail. And there was certainly nuggets that I didn't know there. We learnt a lot.
Yeah, we did. And, we speak to, every season, season 3 now, every season we speak to somebody from our mortgages team, and we always learn something new.
They keep pulling out new stuff.
Yeah, I think really useful episode if you are a first-time buyer or if you know a first-time buyer. They give some really good insights into what you can expect and why you should not be afraid of mortgages.
That's the word, don't be afraid. And they explain why. Yeah. And it's really good. You'll enjoy it. Here we go. Here's the show.
We are here with two of our mortgage advisors from ESPC Mortgages, David and Paul. I'll let you introduce yourselves. So this is not your first time on the show, but just in case anyone hasn't listened, David, do you want to introduce yourself?
Yeah, I'm David Lauder, one of the mortgage advisors with ESPC Mortgages, and worked here for a long time.
And Paul?
Yes, likewise. I'm Paul Demarco, one of the mortgage brokers here as well, ESPC. And once again, David and I actually started on the same day, so I've also been here for a very long time.
Did you start on the same day?
You did, yes. The 4th of July, 2005.
Wow. So welcome, guys. Great to see you both. We're going to start with the obvious question. Paul, David, how is the market?
Busy. Good busy, yeah. I think since the turn of the year, there's been a lot of inquiries. A lot of people getting agreement in principles. A lot of people probably with New Year's resolutions, keen to get on the market. Those probably haven't all quite dripped through yet to actually buy in, but they're on their journey. And I think people that are maybe slightly already had agreement in principles before Christmas, they now are all buying as well. So we've got a good mixture of new inquiries along with quite a few purchases as well. And the way the market is with the mortgages, the rates have been slowly coming down, which is all good. I would say more in the last week or so it's starting to level off, and we're seeing a mixture of increases and decreases of not significance, but there's certainly a lot of activity.
Mm-hmm. And I think if we go back to this time last year, the sentiment has changed so much, hasn't it, from where's interest rates going to be, and we're in a different place. I think there's a little more certainty out there, isn't there?
I think there is, and I think people are realising this is the new norm. Yeah. And there's why wait another 1 or 2 years for something that simply might not happen. It is the new norm. These rates actually now are particularly in the 4s, which probably again showing my time at ESPC is normal. Mm-hmm. So this is still a very good time for getting on the property ladder.
Yeah. Oh, you're going to ask him the question, aren't you?
Yeah. So obviously you're saying that the rates have kind of stabilised, but the Bank of England rates kind of stayed where it is. Do we think that's going to go down?
Yeah, well, you're right. David's right. Fixed rates have come down over the last 12 months, definitely, quite significantly, actually. They have now plateaued out. That's a very good question, and that is all dependent on the Bank of England governor, to be honest with you, because he seems quite stubborn and sticking to keeping the base rate at 5.25. I would like to think in a couple of months' time that there will be at least one decrease, which would probably then have another effect on fixed rates, and they will also decrease slightly as well. So that's about the best answer I can give on that one at this stage.
No, that makes sense. I think we've got an update coming in March. In a couple of weeks.
Monetary Policy Committee meets again in March, and then
you've got the potential gas and electricity costs coming down in April, which will be built into inflation, which I think is what Paul's right in saying will then be a key driver for May-time probably reduction.
I've said May all along. I stick to my
You
prediction.
may. Food inflation has also decreased a little bit as well, so that'll also have an impact. So let's wait and see.
It's a delicate balance because we are now technically in a recession, and if you go too long, too hard with interest rates, which is what the government's been saying previously, you really do hurt the economy, and that's not a good thing. So it is a balance. But I think certainly the trend we suspect is going to be downwards rather than upwards, but not financial advice, merely your own speculation.
Yeah.
Okay, this one's probably a little bit easier for you to answer then, guys, is how much of a deposit as a first-time buyer do I need?
Well, as a minimum, you need typically 5%, and the 5% is against the purchase price or the home report value, whichever is the lower figure. The encouraging thing, particularly for first-time buyers, is that home report valuation and purchase price are much more closer aligned at the moment.
101.4% of the home report value now, or 0.5, 0.4 I think. So yeah, that premium that used to be 5 or 6%, that's come off.
That ammunition that they needed to find in addition to the 5% is not such a requirement, which means that a lot of their money they've saved up is purely just for the mortgage deposit, which makes it a lot easier and means you can help a lot more people. There is one lender, Skipton Building Society, who do 100% mortgage, but that's subject to a number of terms and conditions that I won't go into too much.
What's the interest rate like on that one? Is it higher than a 95%?
Yeah, I think it's late fives, is it?
Yeah, it's pretty much a bit more than the 95%, yeah. But not much more, but it is a little bit more. Okay. But as David says, the criteria for that is quite strict, and so there's a lot of factors which will determine that they've obviously produced this product, so it's a limited amount of people that can actually get it.
As a first-time buyer, in addition, obviously we've got the deposit in cash. What other things do we need to pay for in cash if you're a first-time buyer?
Yeah, well, the two main things are the solicitor's costs. Okay, so that's kind of the main one. And the other main one is, which is compulsory, and the fact they're both compulsory, obviously, is stamp duty for first-time buyers. In anything in excess of £175,000, you need to pay stamp duty. Between 175 and 250, it's 2% of 75,000, and then it's tiered up the way after that. So they're the two main costs. The other costs I would probably suggest they would need to have. The cash they would need to actually to buy the house would be moving costs. So possibly maybe hiring a van or hiring something to transfer all their furniture. They might need to buy new furniture, like washing machines, etc., sofas. So that's a cost as well. They're really the three main costs that I can think of. That's about it, really.
You don't offer free removals as part of your mortgage?
No, we don't. No.
You're not going to van somewhere, no?
Do not, no.
There's a sideline there, isn't there? There's a business there. Just in terms of mortgages then and the entire mortgage market, is there any particular type of property where it's a little bit trickier to get a mortgage on? Is there certain things that lenders don't like, flat above shops?
Yeah, there is trickier ones. Mm-hmm. I think that's where somebody that's an independent mortgage broker comes into their own, because it's a bit like going down a funnel. You've got all the options and then it gets smaller depending on the circumstances, and particularly true with commercial premises, so above pubs, takeaways, laundrettes, hairdressers. I'm not saying they can't be done, but what I'm saying is some lenders will shy away, some lenders will be okay, some lenders will have an understanding of Edinburgh and the quality of unit that they're buying, and the fact that in Edinburgh that's a more regular thing. So it can be done, but you are restricting your options. New build properties are obviously fine for mortgage purposes, but what some of the lenders ask for is a slightly bigger deposit than your standard 5%, particularly with new build flats. And that's using the analogy of a bit like when you buy a brand new car, it leaves the showroom, it depreciates in value. But again, new builds in general, of course, you can get mortgages, and they can include builders' incentives, etc. The only other ones which difficult is in certain previous decades, there was certain types of properties that were like of a certain construction. Timber frame, Orla construction, is it, Paul? Orla construction?
Orla, that's one.
Concrete.
Concrete.
No fines concrete.
No fines concrete.
Yeah.
So again, we think we can find a solution for them, but it's not for all lenders, so that's very specific, but they're more problematic. There's more problems with those.
Another one is, just to sort of interject a wee bit, is cladding that doesn't have the appropriate fire certificate.
Yeah,
so if it's not, usually they're graded, the fire certificates, A1, A2, B1. These three are normally all right with with lenders. But if it's B2 or A3, no one will tend to lend on that because it's too much of a fire risk until it gets sorted out. Haven't come across, thankfully, very many in Edinburgh, which is good. I think they're predominantly in Manchester, Glasgow and London, from what I understand. I certainly had one recently in Manchester, where it was an absolute problem to get a mortgage on it because it was graded B2. So there's no way anyone was going to take that one on until the cladding was sorted. So luckily in Edinburgh and surrounding areas, we don't tend to have that massive problem here.
I wouldn't have put anybody off buying a property that's got a cladding mention, because my experience is that they are subject to a satisfactory EWS1 report, which they get. I have not had a declined case in Edinburgh for that. So although it does have mention it, you've got to remember a lot of these properties that have mention of these are modern flats, 90s, 2000s. So it's very common. So it's people shouldn't be put off by it either.
There is a risk in any building, as we know. I mean, you look at Victorian flats. There is no fire escape, as I used to think about on my top floor. So, there is a risk everywhere, isn't it? But as you say, talk to the experts on that.
So those are obviously the factors that can stop me or become barriers to getting a mortgage regarding property type. But are there any other factors that make it difficult to get a mortgage?
Yeah, there's quite a few actually. Low income, okay? And sort of combination with low income and a very small deposit can be a factor. Another factor would be someone with lots of debt. I'm talking about, say, maybe quite a lot of loans, 2 or 3 loans and a lot of credit cards. And the monthly payments on that are high, although they have a high income. And sometimes that can be mitigated. So the amount of mortgage they can get is not what they think they can get. Another one, believe it or not, is children, okay? Because if you've got, like, say, 2, 3, 4 kids, then that does go against you because, as everybody knows, well, David and I know anyway, that kids are so expensive nowadays. So that's taken into consideration as well. So a factor would be, say, a couple on, say, average incomes with, say, 3 kids with lots of debt. That's a lender's nightmare, to be honest with you. Other factors as well would be if they've maybe had a small debt in the past, like adverse credit. We can still do mortgages for people who have had little problems. If it's just small amounts, like 100 quid here, 200 quid there, like, I don't know, like maybe not paying your council tax, that's usually normally okay, but that can go against you as well. So these are the main ones that I can think of in the ability to secure a mortgage. That's
So the other one I would say probably is sometimes due to your employment status.
Yes, that's it.
Self-employed or short-term contract.
Short-term zero hours contract, fixed term contract with a lack of history.
The 0 hour one, see, I mean, that as a principle seems really unfair, but the fact that counts against you, because it's not guaranteed, is it? But would they look at the pattern over a year or 2 years?
They would. If you'd been a 0 hour contractor for 6 to 12 months, what they would probably do is, believe it or not, they would ask for every single pay slip.
Wow.
And they would take an average of the 12 months of pay slips. But you would need to have, again, with those 0 hours, with a fixed term contract, with a self-employed, you need history, because they need to know that this is not a fluke.
There's a pattern.
There's a pattern and a consistency.
Okay.
And if you're, say, changing jobs in the middle of, and you're also trying to move house, how long do you have to be in employment before?
So that's a great question, Megan. Believe it or not, there is well-to-do big high street lenders who will accept a signed contract by employer and employee without the need of any pay slips at all.
Is that right?
So
if you've got a new job?
The key word is permanent position.
Yeah, I'll give you an example of that. I did a mortgage for a guy down south, actually, and he's started in his job last week, and he moved into his house 2 weeks ago.
Okay.
He could move. He was able to move into the house. This was with Halifax. He was able to move in his house 2 weeks before because he had a signed contract.
Okay.
Yeah, I had a guy that's I spoke to in August, and he's now done his mortgage this week, and he was a PhD student, and he got offered a job contract in August, but he doesn't start until March. But we were able to use that job contract because it was signed by the employer. So yeah.
What about, you talked there about having heavy credit debt built up. What about if you've got no partner credit, you've got no credit cards? Can that actually, in a strange way, work against you where there's no pattern?
Yeah, it can, Paul. It can, certainly. If you've got very little credit, like someone who's maybe, say, I don't know, 23, 24 years of age on a not bad salary, but they're getting a big deposit from mum and dad. They have no credit at all, no credit cards, nothing. That can reduce your credit score. So that can, usually that's okay if they have a big deposit. I think where the problem arises, if you only got like 5% deposit, you're maybe on like, I'll just use an example, maybe under 25 grand a year, and you know, you've got no credit whatsoever. That can sometimes go against you, yeah. One other thing to mention as well is self-employed, limited companies or sole traders, less than a year self-employment, in fact, normally less than 2 years, lenders don't like it. They want a track record as well, so that's difficult to get a mortgage for someone under 2 years as well.
Okay. Would they consider, so say you've got a permanent role and you've got a little side hustle, if they've got books and stuff, do those things count if they can evidence
If
that's a
they've
little
got,
business?
like as Paul says, if they've got a 2-year track record for self-employed and they do tax returns, they can use that in addition to their main income. The only thing is that some lenders will not let you use 100% of the second income. Because they understand that most of your hours are based on your permanent position. But yes, it can be, and it can be treated a bit like overtime or bonuses or something like that. So you can do that in addition. And as Paul, one thing I'd say about the lack of credit score is that it's really common that people, even not living with their parents, but they go in, people living with friends who are names are not in the council tax, not in the gas, not in the electricity, they can't be found because they don't even, through laziness, basically change their bank statements for where they're living with their parents, and that's really a problem for the bank because they can't make a score and make a decision because they don't know if it's a good score or a bad score because they simply struggle to find them.
Okay, so get yourself registered wherever you move to,
Voters,
get on the electoral
bank
roll.
statements, voters roll, all of that.
Those things matter. It's good advice. Okay, so let's assume that you think you can get a mortgage. What's the mortgage process after you've had the offer accepted? What happens?
So basically, you would engage with us, we'd get to know you and what your priorities are, assess that, get an agreement in principle, get your solicitor, go and find your house. Once you get an offer verbally accepted, you would then contact us and we'd have like a standard email which would ask for purchase details, deposit, home report, etc., but then also a shopping list of documents, passports, payslips, bank statements. Once we've got these and per previous discussions with them about the right type of mortgage, fixed, 2 years, 3 years, 5 years, we would go into the marketplace, find the cheapest mortgage for their solution, present it to them, gather their documents and submit the application all, like certainly I'd pride myself in doing that all within the first week.
Okay.
From when they get the application submitted, provided it's a well-packaged case, I would be hoping the lender would be giving us a mortgage offer within a couple of weeks.
Certainly, a lot of them have upped the game, haven't they? It's a lot slicker, the process.
Their systems are a lot slicker as well. They ask for less information because they can find your pay going into it, etc. And then from when you got your mortgage offer, which took a couple of weeks, what you then do, the ball's simply in the solicitor's court and that's it's up to them for there to take care of all the legal matters.
Good.
So if we imagine that we've got our mortgage, we're secured, and it's a manageable amount, and we can afford to overpay a little bit every month, what is the benefits of doing that, and should people be overpaying on their mortgage?
Yeah, they certainly should. Absolutely. What a caution with that, though. Basically, it's a case of don't throw all your eggs in one basket there. You should always build up a little sort of savings nest egg for things like things that can go wrong with the house, etc., etc. Don't throw it all into overpaying. I'm talking about if you're going to do it by a lump sum. If you're going to do it regularly, that's different. Definitely a benefit of doing that. The reason for that is because what will happen in essence is your mortgage debt will drop slowly, and in essence over the total period you'll pay less interest, so you'll pay less back. That's the main reason. Also, if you take a typical, say, 2-year fixed rate and you're overpaying on that, and when you took the mortgage out the first time, you had a 15% deposit, so that's what we call 85% loan to value. So you then overpay for the next couple of years. What that might do, that might bring your loan to value down, and you might be in the next interest rate bracket. So usually they're always in milestones of 5%. So if you have 15%, that's a lower interest rate than it is with 10, and then subsequently 20, 25. So that could drop your interest rate as well when you go to remortgage again. So these are the main benefits that I can think of.
The one thing I would say is that with the overpayment, like everybody thinks when you've got a fixed rate mortgage, it isn't flexible, but the overpayment facility is actually 10% of the capital balance.
Okay.
So that's the allowance. So if you borrow 100 grand in year one, you can pay an extra £10,000 in addition to your normal payments. So when Paul's talking about the overpayments, there is actually within a fixed rate quite a lot of flexibility, and it's very powerful if you get into the habit of doing it.
It's a bit like a pension, isn't it? At the time you think, why am I doing this? But 20 years down the line, you're kind of glad you did if you can. But we recognise just to even get on the ladder for some poor first-time buyers, having a surplus would be lovely, but it may not happen. So we recognise that.
One more thing to mention, there is something called offset, okay, where what happens is that a few banks and a couple of building societies offer that facility where you have a savings account linked to your mortgage and you don't get any interest on the savings, but basically what happens if you put, say, 30 grand into the savings account, say your mortgage was 200 grand, the interest is only based on 170, that kind of thing, so that'll bring it down as well.
In terms of, I'm just thinking of something I've spoken to friends about recently that a lot of people didn't know. In terms of your loan to value, and you said the overpayment can then sometimes reduce that.
Yeah.
If your property increases in value when you come to remortgage, that can also change.
It does. And in Edinburgh over the last so many years, apart from I think the credit crunch, Paul, I think we've had increases in the you guys.
Even in 2009,
it was really good. It was static. Yeah. So I think in Edinburgh we're quite lucky here that, and you're right, Megan. I mean, the valuation goes up. That does drop your loan to value as well.
It's a double whammy because your value's going up, your mortgage is going down, so you're creating the double whammy of wealth.
Yeah. No, that's good.
Double whammy of wealth.
Like
we're taking that. That's going to be the catchphrase and stuff. Talking about mortgages and overpayment, let's think about the average length of a mortgage, because clearly the longer you push the mortgage out, the less you pay, but you're paying it for longer. So in the end, you're paying more, aren't you? But so what's the average, and what's the pros and cons of
Well, the average is, it's not one size fits all.
Absolutely
it depends
not.
what stage of your life you're at, what you can afford.
And what you can get, because
what you can absolutely get, when you intend to retire.
I remember you having that conversation with me saying, listen, at a certain age, mate, you're going to have to show your pension information, so keep your term under, I think it was 18 years or something we spoke about at the time.
It's normally just like, it provided you say to a lender you'll intend to work till at least age 70, that's sort of where the line in the sand is, and they'll still use your fully employed income provided you're not close to age 70. Average term, probably the average term used to be 25 years. I would now say it's a lot closer to 30 years.
Can you go up and can you say I'll have 26 years?
Yeah, you can.
Or there's no chunks, you haven't got to go 25, 30?
What I do with a lot of clients is you mentioned the Paul, is sometimes it's about getting the amount they need, but also trying to make them walk before they can run. And although you do 30 years, particularly for first-time buyers who are younger and they've got time on their side, I actually sometimes say to them, it's 30 years, but this is what your 25-year payment will be. Yeah. And if you phone up your bank and use your overpayment facility, which is another £100 more, you are actually in control, but you are going in the 25-year term. So you're not at 30, but it's at your discretion, it's your safety net.
So you can choose to or not.
You can choose to or not, but it's
so
at your
set
discretion.
It at 30 and then overpay.
Correct.
And if it's Christmas and you decide I don't want to overpay for 2 months, you're fine.
Lose your job, maternity leave, all of these things. You've got the safety net of 30 years, but you've also, with an overpayment facility, got the option to go down to 25, but you're in charge of that. Okay. But what it does require is it requires discipline.
Yeah. And can you start out at 25 and then, something good happens in your life, or maybe you find a partner and suddenly there's more income coming in, and can you say, right, we'd like to shorten the term? Can you talk to your lender about that?
Yeah, you can. You can shorten it, which I'd always recommend if you can, because you're paying it back quicker, more capital, less interest, but it will be subject to case assessment and eligibility, because it's subject to affordability.
And your repayments clearly go up and up.
Correct, because you're crunching numbers.
Yeah, okay, good.
And so do you guys have any advice for somebody if they were coming to the end of a fixed term in the next 6 months?
Yeah, don't panic. Interesting
You're going
one.
to panic for them, yeah.
Yeah. Obviously, we've been doing lots of mortgage reviews recently, and since I think August 2022, interest rates have risen since then. So anyone coming out a fixed rate mortgage over the last 5, 3, 2 years are going to take a big hit. A lot less than it was, like say this time last year. However, we tend to sort of do contact clients 6 months before. Now, as rates are now starting to plateau out, it's difficult to gauge whether it's a good time to sort of fix your rate again just now. However, with the majority of lenders, I think there's only one that I can think of, unless David can think of any more, where you can actually get a rate for them just now 6 months before, and if the rate drops again, you can then go back and change it and get the lower rate for the client. So that's something we've adopted over the last for the last year as well. But basically, don't panic. See what the affordability is. You can actually extend the term of your mortgage as well if you want to, as well, if need be. I haven't done one yet for anyone, luckily, but you
Sorry,
can
Paul,
do that.
so when you say extend the term, so you're coming to the end of your fixed rate and you're paying off over 20 years, you're saying you could then maybe change that
Yes.
to 25 years?
If you're
23,
young enough to do so,
Sure.
yes, to increase decrease the payments down to a manageable level. So
Okay.
that's another option. It's not something I've used yet as such. So they're the main things, and you've just got to keep an eye on the market. It's a case of kind of watching how the market goes as well. It's funny because now what I'm doing is 6 months before contacting people saying what are we going to do about this? Probably let's look at it just now, but let's see how the market's going to go over the next couple of months. As I say, things have plateaued out, so we'll have to wait and see how things go. But in general, that's kind of the advice we're giving people and have done over the last sort of year.
Okay, good advice. Final question from me. Here we go. What's the one piece of advice or information you think that people don't know about mortgages that they really should know? Wow.
To put you on the
That's a
spot.
tough
Did you like that question? That's a really good question.
I would maybe. I don't know. I kind of read.
You don't know
people's
what you
minds.
don't know.
I would probably say 2 or 3 things. One thing I would definitely say is that don't be afraid of mortgages. I think people think it's really hard to get a mortgage. And honestly, if you go about your business, you make your payments on time every time, you get your credit registered to your house, and you've got a set salary, and you're reasonably disciplined with your outgoings.
Have you got lots of stories where people have come in and they've kind of almost written themselves off, and you've said,
Yeah, they're scared.
Yeah.
They're scared. They're scared, and they see this sort of big, I suppose, no elephant in the room, but they think I think they build it up into something that it's
or I missed the catalogue payment 3 years ago,
Yeah,
that's me, I'm not going to get a mortgage.
And they
or-
also like give you, obviously it's confidential information, but we need their bank statements, and they think that we're going to look at every transaction they do and what they spend their money on. It's their money. They can spend it on what they want. So it's not as big a strict thing as what they think. So that's the one thing I would say. The other thing I would say, which you've talked about a lot today, but I'm a real believer in, is that I'm a overpaying in your mortgage. I totally think that if you can get into a good habit of doing that, particularly in your 20s into your early 30s, that will stand you in good stead, because you'll go through cycles in your life. If you get married and you have kids, and I call the vulnerable years for kids 0 to 5, if you can make the overpayments before that comes along, you've really set yourself in good stead for the rest of your financial
Did
life.
I notice as well, there was an offer from Nationwide a few years ago, and it was very much, if you'd overpaid, they did say you can always get that back out if you ever
Payment
needed
holiday,
it.
yeah.
So like almost like the
Borrow
rainy
back
day
facility.
fund.
Yeah.
Borrow back
I think it's not
underpayments.
great, you know.
Underpayments,
Yeah, so not sure everybody does it, but it's just that it's not.
Paul, it's for maternity leave.
Yeah.
Can I digress back a little bit
Of course you
into what factors make it difficult to secure a mortgage? A couple of things to mention are, believe it or not, are childcare costs, because they're horrendous, some of them. I mean, I've got clients that pay £1,000 a month, and that gets treated as a debt. Or maintenance, so a couple divorced or separated paying maintenance to the ex-husband or ex-wife, that goes against you as well, in terms, because it's created as an outgoing, like a debt. Another one is school fees. That's a biggie, because that school fees are extortionate. So all these 3 factors can determine that. And just adding to what David said about one piece of advice, what I found recently is a lot of people are coming in to speak to me on the phone and say, wow, that's a lot less than I thought in terms of mortgage, because they're thinking, they've got this psyche, because they watch the news, like, and I think they're thinking back to, say, last year when interest rates were like 6% for fixed rates, coming in saying, well, that's a lot less than I thought. I says, well, interest rates have come down quite a bit, you know, and a lot of them don't know at the time they can afford it. And I say, well, that is affordable. I could probably do that, blah, blah, blah.
When you consider what your rent is,
Yeah.
and they're preparing themselves for £1,200 and you say actually it's 900 or something, it's, So in some ways, as you say, it's about them just getting a quote, isn't it? Just to see.
Because the one you use, you'll probably use this as well, is someone will say to me, well, I'm paying £1,000 in rent. I say a couple, for example, and your mortgage payments are, say, 1,200 plus your insurance 13, but you're definitely better buying, because although it's 300 quid more, you're paying a landlord, like, obviously, £1,000 a month for the rest of your life. What's the best option here, you know? Because eventually in 25 or 30 years you won't have a mortgage, but if you don't buy a house, you're going to pay rent for the rest of your life, and when you retire you're going to struggle. And that's a good theory. And it don't get me wrong, I'm not trying to take any business away from lettings or like that, because there's obviously, you know,
for the right people, the right time.
Yeah, but the thing is with lettings, that'll be people who want to start off doing that for a few years and then buy. So we both get both businesses get the both of the best of both worlds, sorry, I should say.
Because the payments as well, what people, I get this regularly, is people say I've got to wait 12 months to see what happens, but as you're getting older, the term of your mortgage is through time going to have to reduce, and that almost makes the payments crunchier than any interest rate changes anyway, because your payment, you might have to do your mortgage over 25 years rather as 30 years initially, but so even if the rates went down, the payments are still going to be more because the amount you're doing it over the shorter term. So it's the simple way, as you say, Paul, is if you're paying rent at the moment, the money's better going towards your future is the landlord's future.
Just have a look. Just compare the two things and weigh it up. You know, there are associated costs with buying a property, as we know, with LBTT, as you've mentioned today, Paul, and removals. But it's just doing the maths, and I think it's best to make these decisions by being really well informed, which means talking to ESPC Mortgages. I see the doctors. Good
Well,
segue.
thank you very much, guys, for coming to chat to us. I think there's a lot of really useful information in there, as always.
Yeah, absolutely. No, we appreciate it, guys. That covered a lot of ground. Lots of great advice, lots of nuggets there, and things we haven't discussed before on the show. So,
good.
Thank you.
Thank you.
Speak to you soon.
Fantastic. Good to see you.
Well, as they say in the business, Megan, that was a wrap. And what a wrap it was. I thought that was really good. They went into a lot of detail, and hopefully, you know, what would be our aim here? That maybe there's somebody out there that's listened to that and thought, you know, let's just go and find out if we can get a mortgage.
Yeah, absolutely.
It's no harm in finding out, is it?
Yeah, exactly. And you might be thinking, oh, I don't know how much I can afford if you're starting to look at ESPC for properties. Go and chat to the guys at ESPC Mortgages, and they can help you figure out what your budget is, and then you can move forward in your property search from there.
I think so. And the window is there at the moment. You know, I think we've got, you know, the market's becalmed, the premium over home reports dropped. It's, you know, it does feel like it's a good time if you're a first time buyer and you can get on a lot of it. Yeah. You should. Absolutely. So thanks very much for watching or listening wherever you are consuming this podcast episode. And we will be back again, same time, same place next week. Yeah, we will. So we look forward to consuming with you then. Thanks for watching. See you all listening. We'll see you soon. Bye. Cheers. Bye.